Hey everyone, welcome back to Corporate Decoder. Today FTRA just filed an 8K and I'm seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This is the official announcement about the company's IPO and it gives us a snapshot of how much money they raised and where it all went. So FutureCorp Space Acquisition, one ticker symbol F.T.R.A.U, has filed this report to talk about its big IPO or initial public offering. Think of an IPO as the moment a private company decides to sell shares to the public for the first time, essentially becoming a publicly traded company. This filing is like the official record of that event. The earliest date mentioned here is the 9th of June 2026. This is the day the company officially completed its IPO. The company is called FutureCorp Space Acquisition 1. These types of companies are often called SPACs, which stands for Special Purpose Acquisition Company. They are basically shell companies formed for the purpose of raising capital through an IPO to acquire or merge with an existing company. At this stage, they don't have any actual business operations, just the money raised from investors. It is interesting to note that FutureCorp Space Acquisition 1 is incorporated in the Cayman Islands. This is a common venue for companies going public, often due to its favourable corporate and tax laws. This number, 001-43,330, is the company's commission file number with the Securities and Exchange Commission. Or SEC, it is a unique identifier for regulatory tracking. This table here lists the types of securities. Think of these as different kinds of stocks and warrants that are registered and traded on stock exchanges. The first item is the units. Each unit is a package deal. It includes one Class A ordinary share, which is a basic type of ownership in the company, and half of a redeemable warrant. A warrant is like an option to buy shares at a certain price in the future. This means for every 2 units bought, you get 1 full warrant. These units are traded on the New York Stock Exchange, as indicated by its presence there. Next, we have the Class A ordinary shares themselves. These are the individual shares that are part of those units. They have a very small stated value called par value of $0.0001 per S-share. This is largely a nominal amount. And then we have the redeemable warrants. Each whole warrant gives the holder the right to buy one Class A ordinary share for $11.5. These are called redeemable because the company might have the option to buy them back. These are also traded on the New York Stock Exchange. The company is checking this box indicating it is an emerging growth company. This is a classification under US law that allows newer companies to benefit from certain regulatory accommodations, like reduced reporting requirements. For a period of time, it is a way to ease the burden on young growing businesses. This section, item 8.01, is where companies report other events that are considered important enough to disclose outside of their regular financial reports. Here is where we get to the meat of the IPO. On the 9th of June 2026, FutureCorp Space Acquisition 1, which they call the company, completed its IPO by selling 23 million units. They even had to issue an extra 3 million units because so many investors wanted them, showing strong demand. This is called the underwriters over allotment option, or sometimes a green shoe option. This just reiterates what we saw earlier. Each unit is 1 share of class of stock and half a warrant, with that warrant giving the right to buy a share for $11.5. This is a crucial number. The company sold these 23 million units at $10 each. That means they raised a grand total of $230 million before any expenses. That is a huge amount of money for a company that, remember, didn't have any operations yet. This money is what they will use to find and acquire another company. On the same day as the IPO, they also sold 6 million warrants in a private sale. These are called private placement warrants. They also allow the purchase of a Class A ordinary share for $11.5. These are typically sold to the company's own sponsors or early investors and are often at a lower price than the public units. Here is a bit more detail on those private warrants. The main sponsor of the company, FutureCorp Space Acquisition 1 LLC, bought 4 million of these warrants for $1 each. Cantor Fitzgerald and Company, who helped put the IPO together, bought the other 2 million also for $1 each. This private sale brought in an additional $6 million for the company. This is a really important point for SPACs. The entire $230 million raised from the IPO, plus the $6 million from the private warrants, was put into a trust account. This money is held by a trustee, Continental Stock Transfer, and Trust Company, and it is segregated. This is to protect investors because these funds are earmarked for acquiring another company. They can't just spend this money on doing whatever they want. The $9.8 million mentioned as an underwriter's deferred discount is essentially a fee that the underwriters will be paid later, usually upon a successful acquisition. This section deals with the financial figures and supporting documents that are being filed with this report. And here it is, the audited balance sheet from the 8th of June 2026. This document, which is filed as Exhibit 99.1, provides a snapshot of the company's financial health right before the IPO was finalized. It would show the cash that came in and any initial liabilities. Exhibit 104 is the cover page data in an interactive format, which is standard for SEC filings these days. This is the official signature section, confirming the company is submitting this report. Joshua Marks signed off on this report as the Chief Executive Officer and Chief Financial Officer. In a SPAC, these roles are often held by the same individuals, as their primary job is to find and execute a merger. The report is dated the 12th of June 2026, a few days after the IPO actually closed on the 9th of June. This is typical for the filing process. So, what is the big picture here? FutureCorp's base acquisition raised a massive $230 million in its IPO. This isn't money for operations yet. It is essentially a war chest waiting to be used to buy another company. The fact that they sold all their units and even had to issue more shows there was a lot of investor interest, which is a good sign for a SPAC. The money is safely tucked away in a trust account, which is exactly what investors expect. The red flag here, and it is a big one for many SPACs, is what happens next. They have a limited time, typically 2 years, to find a target company to merge with. If they don't find a deal, that money has to be returned to the shareholders, and the SPAC essentially dissolves. It is a high-stakes game of finding the right acquisition before the clock runs out. Historically, many SPACs that go public with large amounts of cash like this have struggled to find attractive targets, and many end up returning capital. This is the bet investors are making, that the management team here can find a great company to merge with. The biggest concern I always have with SPACs is the inherent deadline and the pressure to make a deal, which can sometimes lead to less than ideal acquisitions. The success of this SPAC hinges entirely on the quality of the business they eventually acquire. Their current share structure, with units consisting of a share and a fractional warrant, is pretty standard for these types of offerings. The $11.5 exercise price on the warrants is also a key number to watch, as it represents a potential dilution of future earnings if those warrants are exercised. That is my take. Stay decoded. If you found this deep dive helpful, please like this video and subscribe for more. The resources I use for research are linked below, along with our Discord community.